everyone, and welcome to yet another episode of Fun and Learn Fridays with 5 Paisa. I am Deepika Asthana, your host for the evening. Now, when it comes to choosing a holiday destination or picking up the latest gadgets, we always think about foreign destinations and foreign products. Yet, when it comes to creating a comprehensive investment portfolio, we limit ourselves to only domestic investments. लेकिन क्या आपको पता है कि foreign flavor can add more value to your investment portfolio? So, joining us today, we have Mr. Gaurab Parija, Head Sales and Marketing at IDFC Asset Management Company Limited. With over 22 years in retail sales and distribution, Gaurab has spent considerable time in breaking down investment products for investors and making them more palatable. Thank you, Gaurab, for joining us today.
Thank you, Deepika, for having me on the show.
Pleasure. Right. So, as I mentioned, we often think foreign when it comes to several aspects of our life. However, when it comes to investing, we usually think local. Now, this could primarily be attributed to a lack of understanding on international investing. So today we are going to break this up into the what, why, how, who, and when of international investing. So my first question to you, Gaurav, is what exactly is international investing?
So thanks, Deepika. And I think it's a little unfair to tell that investors are not comfortable about international investing.
Sure. Mm-hmm.
Globally, if you look at, there is something called country bias, which effectively means investors prefer to invest in assets which are based in their country. So why does that happen? So they might be choosing a phone which is coming from international markets. They can be, like you said, going on holiday abroad, but they prefer to choose in their own markets. It's because it concerns money, which is very dear and precious. And two, they would prefer to invest in companies or assets which they understand and relate to. So while I might be using an Apple phone, I still want to invest my hard-earned money in an equity stock of, let's say, Infosys or TCS. These are random names because I know these are homegrown companies. They're based in India. I know the management and all of that. So that's called country bias. So what is international investing is taking it to the next step. And this was actually to flashback and go back in history, the founding member or the founder of international investing was a gentleman called Sir John Templeton, who actually showed even Americans the need that there is life beyond the American continent to go and invest. And over the years, people have got used to it and slowly started investing in markets outside of their own country. India also, I think the progress has been fairly good. Clearly, there is a long way to go. But of late, there seems to be growing interest. So international investing, long story short, is very simply taking your money and putting it in markets or asset classes outside of India. So India से बाहर आप निवेश करते हैं तो उसको international investing बोलते हैं.
Perfect. I think that is very clear कि आप बाहर invest करेंगे in any asset class. You are investing internationally. Great. So now let's also understand कि we've heard so much about international investing and more of late because there are a lot of AMCs which are launching these international mutual funds, right? And also, like you corrected me in the beginning, there is a lot of exposure as well. So it's not like people are not aware. Having said that, can we maybe talk about 3 to 4 very obvious benefits of adding international investing to the portfolio? And in addition to that, what kind of investors should actually look to accrue these benefits?
Great question. So to answer that, let me step back a little and set the context of why you need to look at investing internationally. Now, over the years, at least one of the things people are now increasingly aware that if you want to create wealth, the critical component is what is called asset allocation. Asset allocation is basically investing in various types of asset classes, equity, fixed income, gold. I really don't consider real estate as an asset class because it's not as liquid, but yeah, real estate and all of that. Now, why is that beneficial? Because we know that depending on the economic environment, various asset classes tend to do well or relatively poorer depending on the underlying market scenarios.
Sure.
Now, what is now also being starting to know that is called typical way of asset allocation. Increasingly, as markets are starting getting more and more linked, people are saying the suggested way of asset allocation should be geographical diversification as well. So apart from buying into asset classes in your country, look at buying into asset classes in various other countries. Why is that important? It's important because what we find, like in your asset allocation, there is no correlation of price movements between asset classes. That means when equity does well, fixed income might not be doing so well and vice versa. By investing in other markets, it could also so happen that when your home market is not doing so well, the other country might be doing relatively better. So if you can find a market which has low to negative correlation with your home market, is the best thing to do, because not only it's diversifying across asset classes, but also geographically. So that's the first of the big benefits as to why you should look at investing internationally.
Sure.
Secondly, I think investors need to understand, aap nivesh kyun kar rahe? Why are you investing? If you're investing in equity, you are saying, I know this company, I know the products, this company is going to do very well, it's going to go at a certain pace, and I want to participate in the growth.
Okay.
Now, if that's the analogy, and like you started off the show today saying, we are so used to using international product. The call we are doing is actually on a platform which is listed in the US, Zoom.
Right.
Many of us use mobiles which are again sold by a US company.
Sure.
Many of us use a travel aggregator which is based in the US. So basically, if we know that there are companies which are doing very well, why not also invest in them? And if they could be so happen that they are listed not in India but in other markets.
Right.
So the bottom line of why we invest is we want to participate in the growth. And what we find is that there are many more companies across the world where the growth engine or the growth drivers are as sound as Indian markets.
Right.
The third thing to remember is that while we are all besotted and fascinated by India and we think India is a great story, which is there's no doubt about it.
Sure.
Do remember that from a global GDP perspective, India only comprises 3% of the global GDP. So by just investing in India, you are limiting your investments to 3% and leaving out 97% of the globe's global GDP. And that's the other reason you should look at investing in international markets. Now, who should consider investing in international markets? I think the answer, if you were to ask me this question 10, 15 years back, I would say an HNI or someone who's created enough wealth.
Right.
But over the years, as the ease of investing has increased, we think anyone who's got a reasonable amount of wealth, and again, reasonable amount of wealth differs from individual to individual,
Sure.
can and should look at international investing up to a certain percentage, again, depending on all the risk profile he or she has, the goals and all of that, which is best done sitting across with your distributor/advisor.
Sure. Very well put, Gaurab. Actually, I think what you just mentioned is, I think in any case, so these are the factors that one looks at when they're making their investment decisions, right? And your point about the growth really hit home, because in a way, if you look at it, by consuming these products, we're already contributing to their growth, right? But over and above the consumption benefit, we're not getting any other benefit, right? I mean, we are contributing to the profitability. So maybe international investment is a way to also get a piece of that pie, which we are in any case helping grow, right? So that is interesting. And one more thing I would like to ask you, actually, because I've heard this a lot when we talk about international investing, is this whole concept around hedging your currency exposure. For example, I've heard that if I have a liability in a foreign currency, let's say I want to send my kids abroad for education, then exposure to international investing can help me kind of mitigate the impact of rupee movement. Maybe is there something a little bit on that?
Yeah, which is a great point. Again, I think one of the other benefits is that, and again, the way our liabilities are shaping up is changing over the years. And I flash back to my college days that typically when I was passing out of college, anyone going abroad was going abroad to do his MS or MTech, which is really higher postgraduate studies. Today, the trend is most families, people, even undergraduation is now in the US markets, and not in US, Canada, a lot of other markets, which effectively means that a lot of families have a dollar liability coming up far sooner than later.
Sure.
And for all practical purposes, for a dollar liability, you've not created any dollar asset.
Sure. Right.
And hence, by investing in international markets, what the benefit it does is it actually helps you create a asset in the underlying currency, which is the dollar, for the liability which is likely to come off. The benefits of that is you are not only investing for a dollar or a currency hedge, but you're investing in a market which is also giving you good returns.
Correct.
So it's a double benefit. And let for one moment assume that the liability doesn't come up and your son or daughter manages to get into one of the best institutes in India. The flip side is hopefully you created wealth in the investment as itself. So it's not that you are getting into an asset class which is giving you suboptimal return just to meet your currency requirement.
Right.
I think that's the point we need to understand.
So then, is it safe to say that foreign investments then have two sources of return, especially if you're investing in developed markets in developed countries like the US? So one is the growth, the return, which in any case comes, and two is the return which would come through currency movements as well?
I won't place too much emphasis on the latter because while over the years, the Indian rupee seems to have depreciated over the dollar and hence given you a slightly better return. To estimate what the dollar rupee movement will be and investing because of that is not something I would really advocate. I would consider US investing purely or global investing purely from the merits of the underlying asset class and the companies. And the cream on top could be your dollar or the underlying currency's appreciation. But to only begin with the fact that I want to invest in other markets to take benefit of a rising dollar or a rising euro may not be the best thing to do.
Understood, noted. I'll just go back to the bit about diversification. So I understand that diversification from a portfolio allocation perspective works well, right? Because while one asset class or one geography is doing really well, the other, India might not be doing very well. Let's look at 2015, right? When India was not doing very well at that time. But the European markets were the best performing at that time. Even Japan was doing well. So any exposure that time would have been positive. But in addition to that, and this is specifically with respect to exposure to developed markets, is it also fair to say that developed markets are less volatile than Indian markets, and thus their inclusion helps in reducing portfolio volatility as well?
Oh, absolutely. I think it's again a very good question, and if I had to just give my answer in relation to the US markets and not look at the other markets, clearly what the US market has demonstrated over the last 10-12 years is that you could bucket the last 10-12 years through various events. So you had the taper tantrum, you had the global trade wars, you had the deflationary period and all of that. So every year either there is a low return globally environment or the environment is good. What we find is that in the years when globally growth rate has been very low or negative, markets like US have held on very, very strong. While most emerging markets seem to have done very poorly. But when there's a big party happening in the world, the US markets may not have given the best of returns, but they've also given good returns on the upside. So overall, do remember in investing, it is as important to catch the upside, but more important to be able to protect the fall in the markets. And that's what I think most developed markets, especially US, has demonstrated over the last 10-12 years.
Excellent. I think I fully agree with you on that it's capital growth and capital preservation. Both are hand in hand. We cannot give one more importance than the other. Perfect. So now that we know what the benefits are, let's talk a little bit about how can we get this exposure. So as far as my understanding is, I can either go out and buy stocks in US or foreign indices, or I can invest through international mutual funds, which is this, I wouldn't say new product, but definitely becoming a popular product in the domestic AMC space as well.
So Deepika, let me at the outset say that you'll get a very biased answer. Having spent my entire career in mutual funds, I will always advocate investors the route of mutual funds, and I'll try to justify that as to why. Now, and again, I'll slightly digress from answering it straight and tell something different. Now, when we create wealth, there are two sources of creation of wealth. One is what you do as a profession, and secondly, what you get from your investments. Now, if I had to ask a question, let's say someone is an architect, someone is a lawyer, you are in the media field and you're working at a brokerage firm. What do you think is the probability that you'll create more wealth, either by focusing on your profession or by focusing on your investments?
Investments,
and 9 out of 10 times, people believe it's the latter, but I think it's the former. So if you were to focus on becoming a better person at what you're doing, I focus on becoming a better sales guy in mutual funds. The architect becomes better in what he or she does. The doctor upgrades him or himself. The chances that over the career, over the lifetime, you will create far more wealth than from your investments. So what we are effectively telling people is that the investments part should be managed by experts. You should continue to focus on your profession. Don't intertwine that. And that's the fundamental reason why I am a big believer that most of your investments should be rooted through experts, in this case, which are mutual funds. That applies to your existing Indian investments. Now, the reason someone would want to go and buy directly into stocks could be very simple, that look, you are in an industry and you know the underlying stock very well, you know the management. Let's say you're in the IT field and you think you know everything what Google does. Then I would be saying, okay, go and buy a Google. And again, I'm not giving a stock tip, but just as a reference point. But 9 out of 10 times, if you don't know about the underlying stock and just basis the fact that you heard about some companies, the AMC, the name of the company, which is AMC, has suddenly gone 100 times, Reddit and all of that. You think you can dibble dabble in international stocks? The answer is the same. Would you want to dibble dabble in Indian stocks, buying a mutual fund? Now, if you believe that you can focus on your profession more and make more money and leave the investment to experts in India, why should it be any different in international markets? So I would, in fact, if not more, because international markets, you clearly don't know the underlying companies. In India, at least you know those underlying companies and the vagaries of how it works in those markets, what are the factors that are impacting those companies and all of that. So from an international investing perspective, I would definitely urge people to look at choosing a mutual fund. And the beauty is that mutual funds offer you a variety of options today, from investing in index funds, investing in multiple themes, ESG, water, you name it, and there are international funds giving you that benefit.
Sure. So I think, of course, I completely agree with you on that. Even in domestic investing, actually, there is a lot of expertise that is required, a lot of time commitment. I personally believe, and you can dispute that, but investing is a full-time job. So if I already have a full-time job, I would prefer to trust the experts than manage my money myself. One must respect the market that much at least, right? So I think, you're right. International investing is the same thing. Just maybe a little bit, I would like to discuss about the thing which you mentioned about exposure to a lot of themes. So this is one thing which is true right now for India, is at the moment you talk about international investing, the first thing which comes to our mind is the FANGs, right? Because that's what we are most familiar with. But over and above that, if we could just discuss a little bit about other opportunities that might be available in international mutual funds.
So like I said, if you were to look at the basket of offerings mutual funds give from an international perspective, there is not only the investments into NASDAQ, you can invest into the S&P 500, you could invest into the FANG, you could invest into ESG companies which follow the ESG model. You could buy consumption-oriented international funds. You could buy gold/mining resources international funds. You could buy global funds. You could buy funds focusing on emerging markets. You could buy funds buying into Chinese markets. So the offerings are huge. Do remember, international investing from an Indian perspective is a complement. It's not the core. It's a complement of the portfolio. So let's say an investor is comfortable with international investing, he or she can take it to say 15, 20, 25%, depending again on risk profile and comfort. Now for the 20-25%, I would strongly advocate that stick to the core offerings and not cut and slice too much, because end of the day you cut and slice, and for that 25%, if you have 20 types of international funds, you are really trying to throw a dart and hoping that one of the dart hits home. So I would say from 9 out of 10 investors or 99 out of 100 investors, just stay to the broad markets, broad large indices or funds which follow the broad market, and you are done. Because again, like in India, the underlying portfolio manager will be finding themes and getting in and out of companies or sectors he or she thinks will do well over the next 5, 10, 15 years. So if currently the theme is the top 10, the Apples of the world, Googles of the world are favored, but if he says things that these are getting overpriced and wants to move into other stocks which are relatively underpriced but still have little growth option, he will do that. So why should we get into that thinking of trying to be over smart or trying to outthink the market?
Fair enough. I think that's a really good point, right? So from that perspective, do you think it would be better for investors who probably already have some sort of a portfolio and then to layer it with exposure to international investments, as opposed to somebody who is maybe just starting their investing journey and just dipping their toes into equities? Then which would be, I think the former would be better, but I would leave it to you.
It's actually a very good question, and I get asked this question quite often.
Okay.
Now, like I said, for someone who is starting off investing in equity, my advice is you first get comfortable in investing in equity in India. First, just get the hang of it. Equity markets can be very, very challenging. Now, for the last 12 to 15 months, people will not believe that, they all think it's a one-way market. Every day I put money, I'm going to make 10% in 1 month or 15%. That's not the case. So just get used to the vagaries of the equity markets, the movements of equity markets, get comfortable. It's great that firstly, I think anyone who's starting to think of investing, I would say is a great thing, because that's very good. Get comfortable. And I hope and I believe that if you're starting on your investing journey is 25, 30 years.
Right.
So it's not that investing in international markets, there's a window after 2 years, it band ho jayega. So nothing, there is no time limit. So get comfortable and then come and start looking at other alternatives. I think so it's not important that from day one of your investing, you start and jump into international markets. I wouldn't suggest that. But again, it all depends on individual risk taking ability and thought processes.
Fair enough. I think that is some sound piece of advice. So quickly, can we also, since we've discussed what international investments are and what the benefits are, touch upon the risks of international investing?
And again, definitely, I think we should talk about that. I think the risks of international investing is, and especially if you do it on your own, is your ability to track what the underlying company does. Two, there is a risk of the underlying currency. So while in the last 10, 15, 20 years, most of the international currencies have appreciated against the rupee, you never know, while that's been in the past, you never know what's going to happen in the future. So the potential of depreciation of the underlying currency would be potentially there. Three, like in everything, any other investments, the choice of the underlying stock by the portfolio manager has a risk. So the normal risk which apply to Indian equities layered with the risk of currency depreciation is the additional risk which you would have. Apart from that, I honestly don't see there is any other risk in terms of your liquidity or all of that, because most mutual funds give you that open-end structure, except that instead of a T+3 window in an Indian equity fund, it's a T+5. So that's the only marginal difference in terms of risk. Because I think most mutual fund offerings which feed into an underlying fund do their own due diligence across multiple parameters to ensure that we give you the best of products and the products which obviously meet our risk filters.
Sure. Fair enough. So, which again then comes down to why it might be better to invest via an international mutual fund than to do it directly. Just one more thing then for our viewers, I want to understand. Can we start an SIP in an international mutual fund?
Oh, absolutely. You can start an SIP in an international fund. Like you rightly said at the beginning of the show, an international fund, which is a feeder fund, it's called a FOF, fund of fund. It's like any other mutual fund in India. The minimums are the same like most equity funds. The features are the same like any other equity fund or fixed income fund. Everything is the same except that the time period of redemption, because we obviously have to go and redeem in the underlying fund and get the money back, is slightly longer. But except for that, everything else remains the same. There could be marginal changes here where the minimum amount for some funds could be 5,000, 10,000. But yeah, you can definitely do an SIP in most international funds, if not all international funds.
That is definitely good to know, because I think SIP is one of the best inventions of the industry, right? For every investor, it's a great way of entering the markets and generating a long-term wealth. So yes, thank you for that clarification. And I just do a quick recap of whatever we have discussed, and then I would request you also to fill in any gaps and share some closing words. So we started with understanding what international funds are, what international investing is, and that basically entails investing in stocks or commodities or any other asset class of which is outside of your country. Then we discussed the benefits of international investing, and these are very, very clear benefits in terms of the diversification benefits. You get the geographical diversification, which kind of will help you reduce any losses that you might witness in your own country portfolio, simply because different countries move in react differently to certain macroeconomic environments, and thus the returns generated also differ across the geographies. In addition to that, another thing that we discussed was that especially developed market equities tend to be a little bit more stable than emerging market equities, and thus they bring some sort of stability to the portfolio. To that extent, while they also bring growth, I think, and as Gaurav also pointed out very clearly, that we must focus on downside protection as well. So that is another big benefit for international investing. And then in addition to that, it's of course the fillip that you can give the returns of your portfolio, because you get to participate in themes which might not be available in your respective domestic markets. Then we went on to talk about how we can invest, and here again, while there are two ways of investing, one you can invest directly and you can invest through international mutual funds. Given that investing is not everybody's forte, and there's a great deal of research involved in picking up the right investment options, it might be better to take the international mutual fund route rather than do this directly. And then of course we discussed the risks. Like any other domestic mutual fund, international funds have the same kind of risk profile. In addition to that, there could be some currency related risk as well. So that's my top 5 takeaways. But Gaurav, please, would love it if you could just quickly also summarize what we discussed.
I think fairly well summed up and articulated as to why the need for international investing. Clearly, I think the last thing I would want to say is that it is not India or international. I think the way to look at it is India and international. That's the suggested way of asset allocation going forward. These are not competitors, these are complement to each other. And that's all I would leave the message, apart from all that you've summed up.
Superb. I think that is actually the perfect way of summing it up, that it's not an either or narrative, it is and, if we want to give our portfolio the correct fillip. So great. Thank you very much for being here today. Much appreciated, and thank you for distilling international investments for us.
Thanks, Deepika, and also would like to thank 5paisa for having us on the show. Thanks, and stay safe, and hopefully you got vaccinated.
Yes, lovely. Thank you everybody, and until next time, we will see you. Thank you.
Bye.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.